This is Nick here, and I'm about to go through the updated U.S. equity market chart book. So no update on the chart in front of us right now. This is the U.S. equity market allocation proxy from the Fed's Z1 report. The Z1 report will come out in a couple of weeks for the end of Q2. But in any case, we are very near these elevated levels of equity allocation right now at 42.8% as of the end of Q1. And so no update to the interpretation of this picture. Basically, if history is any guide, this chart suggests that annualized S&P 500 returns without dividends might be close to 0% over the next 10 years. Then moving on to the business cycle backdrop. So LEIs the LEI index, which you can see here, continues to make new cycle highs, which is generally a positive sign for stocks. But in any case, the U.S. equity market, judging by the S&P 500, is near its all-time highs, near its bull market highs, and we have the LEI index continuing to make new highs. So that is consistent historically with with an ongoing business cycle expansion and potentially an ongoing bull market in stocks. Then in terms of earnings, so for Q2 2018, with 91% of the companies in the S&P 500 reporting actual results for the quarter, 79% of them reported a positive EPS surprise and 72% reported a positive sales surprise. So for Q2, so far the blended earnings growth rate for the S&P 500 is 24.6%. Very strong growth rate, and has been a very strong earnings quarter in general. Now for Q3 and Q4, analysts are projecting earnings growth of 20.3% and 17.6% respectively. That's a slight downgrade from where those projections were when last month's report was published. So we are seeing some downgrading in terms of the forecast for the next two quarters. Something to keep an eye on. Obviously, earnings growth has been very high and expectations have been very high, which can set the bar so high that it's difficult for companies to beat expectations. That's something that I will continue to follow through these reports each month. Then in terms of the global growth backdrop, so we are, I would say, generally seeing some deceleration in the global growth, judging by the global manufacturing PMIs on a country-by-country basis. So here I just have basically the largest economies in the world, and all still above 50, but we did have downticks in the U.S., Japan, and Chinese manufacturing PMI numbers. A little bit of an uptick there on the German number, which you can see here in green. But in general, yeah, there does appear to be some deceleration of the global growth backdrop, and that's worth keeping an eye on. But my framework for this chart remains unchanged. It's basically if any of these go below the 50 line, which divides the expansion and contraction interpretation for those respective economies. Then U.S. financial conditions have continued to ease. They've eased slightly since last month's report, from minus 0.78 to minus 0.84. So this represents an easing of conditions here. My key threshold level is this minus 0.50 level. If we saw the gray line or financial conditions drop through there, that would be a negative sign. Since we haven't had any new bull market highs since last month's report, this chart is unchanged. The last bull market high was still at the end of January 26th, when 83% of the member stocks were above their respective 200-day moving averages. It's a very strong reading, and historically breadth has been weaker than that at major market tops, so that is did not and still does not appear consistent with the idea that January represented a major market top. We've also seen the cumulative advanced decline line for the S&P 500 companies intermittently making new all-time highs over the past 4 months or so, which is suggestive that this rally since the beginning of April has been broad in terms of participation and could be a sign that there's some very real underlying strength in the S&P 500. Then in terms of market sentiment, so this is the AAII Bulls Bears survey, and right now we're kind of at a neutral reading here at 54. So my interpretation here is neutral. This is a chart that I look at with a contrarian perspective. So we've had some fears, I think, over trade war and most recently over Turkey, and that I think has dented sentiment somewhat, which is generally, at least in my view, a positive sign for stocks. Stock markets need a wall of worry to climb. They need uncertainty in order to continue to move higher. Then margin debt. So we're not updated data point here. Really no update to the interpretation. I mean, margin debt generally it has been tending to move higher with the stock market. So we're not seeing this kind of late cycle behavior of margin debt building relative to the stock market, which could be indicative of a final phase of the bull market. Don't need to see that to get negative on the equity market, but certainly if we did see that ramp up, that would be a negative sign. Then in terms of the correlation and volatility picture, so we've seen correlations among the sectors declining, which has generally been probably supportive of equities. The volatility within these sectors on average has come up this year and remains at a more relatively elevated level, although over the longer term picture I would say that these are both low levels in terms of correlation and volatility, and my interpretation here is that that's somewhat of a negative over the medium term, something to keep in mind. Then uncertainty. So as I mentioned, uncertainty a minute ago, I mean, we've had some falling uncertainty here, perhaps on some fading of fears over the trade war, although that is still bubbling under the surface. It just depends on what's going on the day as to whether that's top of mind. But in any case, we're not at the sort of 50 level here, which I've assigned as the key threshold in terms of a negative interpretation for this picture. In terms of the VIX curve, still positively sloped, which is generally a positive sign for stocks. I mean, this is somewhat of a trend-following framework, as opposed to some of the contrarian frameworks that I mentioned earlier. Similarly, here we just have the price chart, the open, high, low, close bars for the S&P 500 with the 50-day moving average in gray and the 200-day moving average in black. 50-day moving average still above the 200-day moving average, and we see the S&P 500 generally making higher highs and higher lows here since the beginning of April. I'd say the market's actually performed pretty well in terms of the price action picture since the beginning of April, and has not yet breached to new highs relative to that 2873 number from late January. But that's something that I would not be surprised to see, as I said, with the underlying breadth looking very strong for the S&P 500. Year to date, the market is up about 6% for the S&P 500. The sell-side forecast coming into the year ranged from 0% to plus 10%. That's kind of a typical, I guess, forecast range. But what's interesting to note is that only going back to 1928, which is when this chart starts, and that's as far back as the data goes on Bloomberg, the S&P 500 has only returned between 0 and 10%, 17% of the years. 51% of the years it's returned above 10%, and 32% of the years have been negative returns. Then my checklist here, so valuations still negative. LEIs making new cycle highs, that's still positive. Earnings growth has been very strong, with the one caveat that the forecasts seem to be coming down a little bit, and these high expectations do create a high bar for these companies to try to beat going forward. In any case, that's a neutral to positive characterization on the earnings picture. Global growth, neutral to positive. We are seeing some deceleration, but most of the major economies still above 50 on their manufacturing PMI readings. Financial conditions still look supportive of stocks, so characterization there is neutral to positive. Market breadth, I'd say, is positive on two levels. One is that the last high The readings just didn't look indicative of a major market top. I would have expected to see much weaker breadth at the January 26th high if that were to look like a major market top. And then the cumulative advanced decline line has been very, very strong over the past few months. So I'd say that the breadth picture is very positive. Market sentiment, that's a neutral interpretation. I mean, we looked at the AAII bulls bears. That's kind of in the middle of the range historically. Margin debt, not seeing any warning sign there specifically. The correlations and volatility, that's a negative characterization medium term just because volatility is very low generally, even with the uptick we've had this year. And correlations generally historically at a pretty low level as well. Uncertainty, it's been coming down generally through this bull market going back to 2009. There is still some uncertainty out there that can obviously develop either way, but it's healthy to see some amount of uncertainty for the purposes of the bull market being able to continue to move higher. Then the VIX curve, that's a very short-term indicator, sort of a trend-following type indicator. That remains positive. And then the sort of the technical price picture, I mean, we're generally seeing higher highs, higher lows, and the 50-day moving average above the 200-day moving average, which is more of a medium-term indicator, and that is generally positive. So short-term outlook within the next 6 months is overall positive with medium to high uncertainty, and the medium to longer-term outlook is neutral to negative with high uncertainty. Then I've got on the PDF version my written conclusion and thoughts, but for the most part have shared those here. So we'll leave it there for now.